Good morning, everyone, and welcome to the first Treasury Strategies Corporate Cash Briefing webinar of 2018. You are listening to the largest and longest-running conversation on the issues affecting corporate cash decisions in our industry. My name is Kevin Ruiz. I'm a principal with Treasury Strategies, a division of Novantas. And I'm joined today by my colleague, Managing Director Tony Carfang, as well as today's panelists. Michelle Price, the Associate Policy and Technical Director with the Association of Corporate Treasurers. Debbie Cunningham, the Chief Investment Officer for Federated Investors. And I'd like to introduce everybody to Zhu-Young Lee. She's the Managing Director with Fitch Ratings. Also this quarter, we're going to be joined by Denny McMahon. Denny is a China expert and an author on an upcoming book on China. We'll be talking to him about China's path in 2018 and the obstacles that China may be facing in this new year. As usual, we will be discussing the high-level macroeconomic issues, regulatory and legislative issues, and the geopolitical issues that our corporate treasury audience is thinking about and asking questions about right now. Before we begin, I want to remind everyone who's registered for this session that in a day or two, you're going to receive a copy of the presentation and a link to this recording. If you wish to ask any questions during this session, you can do so in the question box in the bottom right-hand corner of your screen. We'll handle those questions offline in the coming days. So, Tony, I'll let you kick off 2018, and we'll talk about the high-level cash discussion.
Well, thank you, Kevin. As usual, we're going to begin by reviewing the corporate cash levels around the world, and this is based on central bank statistics that are published just within two weeks prior to these briefings. And what we see here across the 4 jurisdictions, again, is that corporate cash is continuing to rise. Year over year in the U.S., we're $2.4 trillion now, up 8%. Year over year. UK corporate cash is up 11%, Eurozone cash up 7%, and Japanese corporate cash is up 5%. This is actually surprising us. We would think that with economic growth in the U.S. and around the world, some of that cash would be put to use. We have some hypotheses about this, and it may well be that companies have just decided to have a higher cash cushion on their balance sheet, and that could be a long-term secular trend here. If we look at these charts, in fact, going back to September of 2000, where our data series, where we chose to begin our series, you see very consistent patterns. I mean, in the U.S., it's just under tripled over that period. The Eurozone has tripled, and the U.K. has just slightly more than tripled. Now, Japan, we have a different phenomenon going on that we'll talk about later. But the consistency here really says that this may be a secular trend among corporations as opposed to specific economic indicators within a given country here. Now, what's going to be interesting is under the new U.S. tax law, we have cash repatriation possibilities coming up, and people are estimating anywhere from a couple $100 billion moving from outside of the U.S. into the U.S. Up to a couple $1 trillion moving there. We ought to be able to see that in these charts because it's basically the large corporations who are global that these charts reflect, and we ought to be seeing, for example, when a U.S. company's cash in the U.K. is showing up here on the U.K. chart, not the U.S. chart. So if Apple moves $50 billion from the U.K. to the U.S., we ought to see that on this chart. It'll be interesting to watch that going forward. We're also seeing higher interest rates, and just since the beginning of the year, the U.S. 10-year Treasury has gone up, double-digit basis points, and that may impact the cash levels as well. Now, when we look at the time series, we actually see very strong regression lines, very tight distribution, which again reinforces the hypothesis that the growth in corporate cash is independent of specific economic events within each of the jurisdictions. I mean, we've got R squares of 0.95, 0.99 on here, as you can see. And this 17-year time series reflects time periods of high rates or low rates, rising rates, falling rates, yet we have correlations of 0.95. I mean, which is really incredible, and that's really kind of telling us that there is a long-term macro movement among the way companies are managing their balance sheets. Now, if one interesting way to look at this is geographically by region, and looking at corporate cash as a percentage of gross domestic product in each of the regions. And since September of 2000, we can see in each jurisdiction, the cash as a percentage of GDP has increased. Now, each jurisdiction is actually at a very different base, which may affect, that may affect the economic fundamental and the differences between regions. But the growth rates, you see, I mean, the growth rate from in the U.S. 9% of GDP to 12% of GDP isn't all that different from, say, the U.K., which went from 23 to 36%. It's a 30, 40, 50% increase there. The same in Japan. It may indicate, a more conservative bent, more of a concern about risk, perhaps. But so interesting to take a look at. Now, when we look at cash relative to nominal GDP in each country, here's where we actually see some interesting coefficients. If you look at in the U.S. chart, again, a very, very tight trend line in R-square 0.96, which says that cash is tightly tied to GDP. If you look at the slope of the line, that the 138, the slope means that for every $1 trillion increase in U.S. GDP, corporations are holding an extra $138 billion of cash, and that's a trend line that has gone for the last 12 years. In the UK, for a £1 trillion increase in GDP, companies are holding an extra 447 billion pounds of cash, and you can see the coefficients here. We're going to do some other interesting statistical analyses on these. We have a number of ideas that we think will shed more light on this. So in April, in next quarter's cash briefing, tune in. We're going to break this down in more detail. Now, one other thing to look at in terms of corporate cash, everyone's concerned about what happens with the tapering of the stimulus of the last 10 years, or the unwinding of central bank balance sheets. And clearly, the U.S. and the UK are well into their programs, as you can see from the charts. The ECB has claimed for several quarters now to be tapering or unwinding or something. Whatever it is they're doing isn't showing up in the numbers yet. It's kind of interesting. And Japan, just this past week, announced that they're going to taper their bond buying. An interesting thing here on the U.S., if you notice, late in 2014, reserves held by banks at the U.S. Federal Reserve Bank peaked at about $2.8 trillion, and it declined until basically the beginning of this year, and then we saw a spike beginning in the second quarter and still at an elevated level. We've had a couple of theories here. One is, and I don't think it's a coincidence, the decline, the peak in the second half of 2014, following to the trough in late 2016, totally corresponds to the tightened U.S. money fund regulations that were announced in late 2014 and implemented in October of 2016. And we believe that as assets left prime money market funds in the U.S., basically that meant funding for bank commercial paper went down, and the banks refunded their balance sheet by reducing their reserves at the Fed. Now, we have a spike, and as we've talked around in the industry, that there's some sense that this spike may actually be due to U.S. Treasury machinations as they're trying to stay under the debt ceiling limit, which keeps getting kicked down the road a little bit. And as we've investigated this, and we haven't firmly confirmed it, but with the Treasury doing some transactions itself and increasing its own deposits at the Fed, whatever we think that might explain it. So in any event, there's a lot going on. Rates in the U.S. are higher. GDP growth around the world is increasing, and repatriation of the U.S. tax changes means that there could be a lot of flows here, and it will be very interesting for all of us to continue to watch this. Now, before we transition, I'd like to mention on January 25th, Treasury Strategies will be conducting its 12th annual State of the Treasury Profession event. And this has two components. Every year, as you all know, we do a major global survey of corporate treasury priorities, and we'd like you all to participate in that survey. Tell us, it's a very simple, less than a 5-minute thing where you check boxes about your various priorities, and then we do the State of the Treasury Profession webinar. And typically, we have 11, 12, 1,300 participants from about 40 different countries participate in that. We invite you all to join. The links are on here, and you'll be getting a copy of this deck, or you could simply, in the Q&A box, type in the letters SOTP, State of the Treasury Profession, and we'll make sure that we'll send you these links, and you'll receive an invitation. So with that, let me turn it back to Kevin and continue with the rest of the program.
Thanks so much, Tony. So, our corporate treasury clients, and honestly our bank clients for the last, I don't know how many years, have been asking a lot of questions on China specifically. The potential impacts, the decisions that are made in China and how that affects the global economy, how that impacts financial measures in Europe, the U.S., and on the impacts of global treasury functions. The topic of China and issues related to China have come up so frequently that going into 2018, we as a firm felt it was important to have an actual expert join the discussion. So today we're joined by Denny McMahon. He's a fellow at Macro Polo, a China-focused think tank here in Chicago, and he's the author of a book that's coming out called China's Great Wall of Debt, Shadow Banks, Ghost Cities, Massive Loans, and the End of the Chinese Miracle. I know, right? It's a bomb-throwing title for sure. The book will be published by Houghton Mifflin Harcourt in March. Now, Denny spent 10 years working as a financial journalist in China. Between 2009 and 2015, he was with the Wall Street Journal in Beijing, where he wrote about China's banking and financial sector, focusing on rising debt levels, urbanization, and the role of the state sector in the economy. Previous to that, Denny wrote for Dow Jones Newswires in Shanghai, where he focused his reporting on the yuan, I'm never going to get the pronunciation right, and also on China's foreign exchange market. Denny also contributed to the Far Eastern Economic Review. Prior to joining Macro Polo, Denny spent 2 years as a fellow at the Woodrow Wilson International Center for Scholars in Washington, D.C. Denny, thanks for joining us.
Thanks for having me, Kevin.
So let's start by discussing this new book. Maybe start by talking about the main themes of the book and how those themes impact our corporate treasury audience.
Okay, thanks, Kevin. Well, what I write about in the book is how the debt and dysfunction levels in China's economy has now kind of got to an extent where at this point some sort of economic reckoning is all but inevitable. But rather than wade in at 30,000 feet where most of the debate about China's economy takes place, I write about it from the ground up, looking at the mechanics of how China's economy actually works and focusing specifically on how and why so much waste and debt has accumulated and why it's proving so difficult to fix.
Okay, so in that battle against waste and debt, I guess it seems that China is, I mean, my impression is starting to make some headway. Is that a fair assessment?
Yes, it seemingly is, although that comes with some significant caveats, which I'll get into in a little bit. One of Beijing's big-ticket reform items for 2017 was deleveraging, and on that front, it's made some headway. But not necessarily outright success. Now, what I mean by that is that the extent to which the economy is in fact deleveraging, it's not happening in absolute terms, right? So the total stock of debt is still rising. Now, however, when we talk about the debt to GDP ratio, so the actual stock of outstanding debt relative to the size of the economy, well, on that front, we're making headway. So in the middle of last year, the growth of that ratio effectively stalled. And although we don't have debt for the entire we don't have data, for all of 2017 yet, it looks as though that ratio sort of increased marginally. Now this is all very significant because if we look at the IMF's data for debt to GDP since, for the last 8 years, they reckon that in 2008, China's debt to GDP ratio was about 140%, and that by the end of 2016, it was up to 242%. So that's an increase of 100 percentage points over the course of 8 years. And so the idea that the government has been able to stall that accumulation, and not only stall it, but effectively achieve its holy grail, which is to stall the accumulation at the same time as allowing economic growth to continue at its same robust pace, that has been a very major achievement.
Okay, so you were talking a minute ago about caveats. What are some of those caveats that you were mentioning?
Well, there are reasons to think that this turn of events isn't sustainable. So firstly, it's been made possible because of higher producer price inflation and a rebound in exports, both of which boosted profits at China's big industrial firms and so reduced the need for them to borrow. However, the government doesn't have much control over either. So exports will depend to a certain extent on what the dollar does and whether the Trump administration decides to go after China on trade. And as for inflation, well, at the end of last year, there were already signs that producer price inflation was moderating. Moreover, the other factor that made this sort of moderation of debt accumulation happen last year is that the government stimulated the economy, but it stimulated it to a degree that is far in excess of what's generally appreciated, because it did so by spending down savings that had accumulated over the past couple of years. Now, those savings are now gone, meaning that Beijing will have to borrow more if it wants to stimulate to the same degree as it did last year, and that's something the central government has always been very reticent to do.
Yeah. So, if I understand you correctly, I guess what you're saying is for China to deleverage, Beijing needs to, hope and pray that the macroeconomic stars align?
Well, not entirely, because deleveraging is also happening on another front, albeit one that gets less headlines. So the financial regulators are very actively and aggressively winding back credit in the financial system, but their actions are perhaps best thought of as, de-risking rather than deleveraging. So, for example, one of the concerns that has sprung up around China's financial system in recent years is that it's increasingly taken on some of the characteristics that allowed contagion to spread through the US financial system when Lehman Brothers collapsed. So whereas traditionally Chinese banks have funded their loans almost entirely from their ample deposit bases, in recent years both banks and shadow banking institutions have increasingly borrowed from each other. Now, that's partly because some banks, the smaller banks in particular, have come up against the limits of their deposits, but it's also because interbank lending helps them structure loans in ways that allows them to get around regulations, and in particular to fund more speculative ventures that Beijing says they're not supposed to be doing. But over the last year, China's central bank, armed with new tools for liquidity management, has slowly tightened monetary conditions and has thrown that growth of interbank lending into reverse. And meanwhile, there are other sort of promising signs as well. So over the last couple of years, and certainly in 2007 in particular, the banks have very aggressively started writing off loans, and the banking regulator has started handing out fines fairly freely to any sort of violations of the regulations. And so whether you call all of this deleveraging or not, it's a real cleanup of the financial system. The question is, however, whether it will stick.
Why wouldn't it stick? I mean, the government recognizes there's a problem, obviously, right? So why would there be, backsliding?
Okay, so this is where politics gets involved. One of the theories that has had a lot of currency among China circles over the last few years is that Xi Jinping, the president, spent the first 5 years of his tenure as president consolidating power so that he could make the tough decisions necessary to reform the economy in his second 5-year term. Now, certainly his reform agenda hits all the right notes. So he wants to deleverage, he wants to pare back all the industrial overcapacity which plagues the economy, he wants to deal with the excess of housing that has sort of sprung up in many of the cities around the country. He wants to cut the cost of doing business, he wants to alleviate poverty, he wants to, deal with the pollution problem that sort of deals with, that's a problem across the entire breadth of China.
Mm-hmm.
However, all of these things, all of these agenda items essentially will, well, not all of them, but most of them at least, will take a bite out of growth. And so the question is, what happens to reform if growth starts slowing meaningfully? And so Xi Jinping may have consolidated power, but it's still unclear just how far that power extends. There is a tendency for us outside of China to think that the central government in Beijing as being all-powerful, that it gets obeyed throughout the far reaches of the country. But that has never been the case. In fact, there's been a long basic tension between the centre and the provinces. And so the technocrats in Beijing typically try to rein in waste and excessive debt creation. And meanwhile, the governors and the mayors out in the provinces, they constantly lobby for looser monetary policy. And when they don't get it, they find ways to get around the rules. And so the basic bias, there's this basic bias of the need to deliver fast growth at all costs. That's hard baked into China's political system for a host of reasons. And whereas the senior leaders have been trying to break that down for years, they've always struggled to. And so if you listen to Xi Jinping at the moment, he talks of the need for the Chinese economy to refocus on the quality of growth rather than the outright pace of growth. But there are plenty of barriers at the lower levels of government that could easily prevent him from achieving that sort of transition.
So what does that mean for deleveraging? If things look, I guess, fairly rosy now, what should our audience today be looking for in the future, in 2018?
Well, I feel that when it comes to deleveraging in China, we've been in a similar position before. In fact, we've been in this position repeatedly. And that is that the government declares that it's making headway on reining in credit. Certainly some of the data shows that things are moving in that direction. Perhaps it's, success in curtailing local government borrowing or some aspect of shadow banking. But what's really happening is that the money has just moved elsewhere. Right. It's effectively Goodhart's law in effect. That's, when a measure becomes a target, it ceases to be a good measure. And that's what happens time and time again in China. The regulators bring some aspect of the financial system under control, and the money invariably moves to a part of the system that no one is watching. Now, I can't say for sure that the recent wave of deleveraging is obscuring some shift in the way debt is created, but that has been the basic trend of the last decade. Effectively, the financial system has sort of geared itself up to be able to respond to regulations in such a way. And so it's probably a little bit too early to declare victory or even progress until we kind of see where things stand in over the next 12 months. Now, certainly, in some ways, taking a more macro perspective on this, I mean, in some ways it is difficult to talk about the risks to China's economy. Because, I mean, Xi Jinping, he can make all the moves necessary to bring the risks under control. Sorry, pardon me. There is nothing to say, pardon me, that Xi Jinping is incapable of bringing these things under control. I mean, he definitely seems to be the strongest leader in China since perhaps Deng Xiaoping. But even if he does, it remains an open question as to whether the authority we assume he has today will last in the face of slower growth. So officials might acquiesce to reforms today, but support might be short-lived if growth falls too far. Now, of course, when it comes to sort of talking about risks in the Chinese economy, people have been sounding the alarm for years. Now, that doesn't mean that China doesn't have problems, nor does it mean that the government has managed to fix its problems. As far as I'm concerned, all that really means is that the authorities have been extremely good at keeping the machine moving without fixing the underlying problems. Now, at the moment, there seems to be an unprecedented appetite for growth in Beijing. Now, what is less clear is whether Beijing is genuinely in a position to carry them out.
So what does that mean for the global economy? If China doesn't manage to handle its what sounds like debt problems, essentially, and eventually confront some sort of economic reckoning, what does that mean for the rest of us?
Well, that's an incredibly difficult question to answer. Maybe as a starting point, at Davos last year, Xi Jinping noted in a speech that since the global financial crisis, China has been responsible for generating something like 30% of global economic growth. That sounds like a big deal, but that growth hasn't benefited the globe like growth in the United States does. So whereas in the United States imports a lot, effectively supporting growth in other countries around the world, in China its trade model has been far more lopsided. And so it imports a lot of commodities, a lot of minerals and metals, and it exports a lot of manufactured goods. In fact, it exports effectively, I think it's about 3 times as much as it imports. And so many of those imports are things that can then be processed for re-export. So China's growth has been good for China and a handful of commodity exporters like Australia and Brazil, but it hasn't made a sort of a broad-based contribution to global well-being. However, that's now rapidly starting to change. China has an increasingly affluent society, which is spending more and more on things that China can't produce domestically. So it's things like, internationally ranked university education. I mean, that's something that is it's a real shortage of supply of that in China. And so you've got tens of thousands, in fact, you've got hundreds of thousands of Chinese students going abroad for a university education. China can't produce agricultural products on a scale or of a quality that satisfies its growing middle class. Yeah. And so they buy billions of dollars worth of soybeans from the United States and increasingly is developing an appetite for things like, American cranberries and Maine lobsters. And then it also can't produce high quality consumer goods. Things like, the Chinese consumers continue to flock to French luxury brands. And when Chinese go to Tokyo on holiday, they come back with caseloads of Japanese electronic goods. And they also can't produce high-end electronic goods like airplanes, such that Boeing executives believe that Chinese demand for air travel currently supports about 150,000 jobs in the United States. So how this diverse and fast-evolving tapestry is affected by deeper Chinese economic problems, I really don't know. But I thought at this point it might be worth quoting Rashir Sharma, who is the Chief Global Strategist at Morgan Stanley Investment Management. And he wrote in 2016 that if every previous global recession started with a downturn in the United States, the next big one is likely to begin with a shock in China.
Thanks for sharing, everybody, on the call, Danny. Very much appreciated. Honestly, I think we all are anxious to see what 2018 turns out to look like, for the global economy, but especially for China. Denny, thank you so much for your insight and your time today. Everybody here that's listening, let us know what you think about this topic by commenting on the webinar, on LinkedIn, Twitter, ring a cowbell, send me an email, whatever. If we do have a sufficient response, a positive response, I think we might make China a standing topic for 2018 and follow this trend and see where it goes and force Denny to keep coming over and being a part of this webinar. So thank you, Denny. Let's transition over and let me introduce our panel again. I welcome again Michelle Price, the Associate Policy and Technical Director with the Association of Corporate Treasurers, Debbie Cunningham, Chief Investment Officer with Federated Investments, and I want to introduce our audience to Ju-Young Lee. She's the Managing Director with Fitch Ratings. So we're going to start by talking about Libor, its potential demise, its replacement. So Michelle Price, if you're on now, let's start at the top. The big question is, will Libor continue to exist post-2021?
Well, that's an interesting question, Kevin. I mean, what I would say, just to start off with, is I was at a Libor seminar 2 nights ago, and it was interesting that some comments made by some of the bank panelists was that corporates don't seem that concerned about Libor. And I really think corporates need to take note and really have a voice in what they want here. But to go back to your question, will Libor exist post-2021? I think it's worth just reminding ourselves on the current situation with Libor. So ICE Benchmark Administration, IBA for short, is the current or is the administrator of Libor and has been since early 2014. ICE Benchmark IBA have stated that they will continue to publish Libor post-2021 if the demand's still there. Now, in my personal opinion, the biggest challenge they're going to have is retaining the panel banks, making sure that these panel banks will contribute post-2021. At present, there's a huge heavy cost and responsibility being a panel bank, and these guys aren't being paid for this. It's sort of voluntary, and I use voluntary in open quotations. So you've really got, within these banks, you've got the trading side of the bank, the trading desks. They want Libor to continue, but then you've got the risk and their compliance department saying, whoa, Libor's really too risky for us to be a panel bank going forward.
So Michelle, what do you think the roadmap is going forward? How do you think they're going to do this?
Well, I think, again, we've got to look at here on what IBA's roadmap is for Libor, what they are trying to do with Libor, and they are in the process of reducing the risk for these panel banks, and they've got this two-phase plan, which we actually don't hear a lot about in the press, and you've really got to dig and have a look for it. So phase one of IBA's evolution is really to further anchor Libor in actual transactions. And they have a standardized waterfall where these transactions aren't available. And what's even more interesting is this phase two that they've got, where they're talking about panel banks submitting the raw data into IBA for them, IBA, to actually calculate and then publish Libor itself. Now, again, in my opinion, IBA really need to push ahead and implement phase one as soon as possible if they realistically want to get to phase two and there's any chance of Libor surviving.
Gotcha. As an aside, before we got started today, Michelle's been participating in this forum for about a year and a half, 2 years, something like that.
Yeah, something like that.
It took Denny, a fellow Australian, to recognize that Michelle is an Australian and not a native of the UK. So, but back to the conversation. Michelle, an Australian living in the UK, what's the view from London?
So what's happening over here with a potential alternative for Libor is SONIA. So the UK's Financial Conduct Authority and the Bank of England, they're really pushing ahead with this alternative relative risk-free rate of SONIA. And SONIA stands for Sterling Overnight Index Average. Now, immediately there's, one issue with SONIA as it currently stands. SONIA is just an overnight benchmark. It doesn't have any tenors. It doesn't have, a 3-month or a 6-month tenor like Libor. So if a corporate today was to use Libor to manage its interest rate risk, it would really have to reset its floating rate on a daily basis. And secondly, Libor includes this liquidity and credit premium, while the risk-free rates, and SONIA being one of them, don't. So if you're really comparing apples with apples, what will we end up with? We'll end up with potentially SONIA plus a margin, and that margin might be bigger to compensate, or it might be just an additional third element. We could have SONIA plus margin plus a third element. So they're two key challenges that we've got here in the UK with SONIA, and equally these challenges exist for the other global risk-free rates.
Sure. And so, the standing question, what's that mean for our audience today, both our corporate treasury practitioners as well as banks and other folks in this industry?
Do you mean on a global basis, Kevin?
Yeah, absolutely.
Okay. So what we mustn't forget here is that corporates don't just use their local currency Libor. If you're a UK corporate, you're not just using sterling Libor. Over here, actually, US dollar Libor is used extensively. So in the US, we're having to keep up with what's happening just not here in the UK, but in all these other countries. So in the US, the Alternative Reference Rates Committee has chosen a new Treasury's repo rate, and that's linked to the cost of borrowing secured against US government debt. But this benchmark will have a different risk profile to SONIA because it's based on secured transactions, while SONIA is based on unsecured transactions. So I guess what I'm saying is, these risk-free rates aren't going to be the same. And in Europe, we've got the ECB, the European Central Bank. They've announced they're going to start looking at an overnight unsecured index rate before 2020. So again, unsecured, closer towards the SONIA equivalent than the US one. Now, corporate treasurers are going to need to have to factor in that basis risk, that credit risk and liquidity premia that I mentioned before when they're comparing, say, US dollar and sterling interest rates. They'll have to do that for all currencies.
Gotcha. So before I transition over to Debbie and then Ju Young, and Tony's over here chomping at the bit as well, so I'll call on him. One more question for you, Michelle. Is there anything else that you wanted to add? Is there anything else that we need to know before Debbie chimes in? Well,
I guess my last point is, if LIBOR does exist post-2021, this in itself can present some extra challenges to corporate treasurers. Some corporates are going to have loans which go out 20, 30 years that currently reference LIBOR. Now, if LIBOR continues to exist, then will they be forced to change the benchmark, or will they have their old contracts referencing LIBOR and potentially new contracts referencing a risk-free rate? So it complicates things. This will have a knock-on impact, as all corporate treasurers know, to their derivative hedging. It's going to have a knock-on impact to their intercompany loans and also their interest rate P&L volatility. So there's a lot of things to be thinking about.
That's a lot of things to be thinking about. Absolutely, Michelle. Thank you so much. Debbie, any thoughts from where you're sitting?
Thanks, Kevin, and good morning, everyone. Michelle covered the topic very thoroughly. I will reiterate a few things with regard to what's happening in the U.S. As she mentioned, the ARRC, the Alternative Reference Rate Committee, has come up with, again, what is an overnight a preferred rate for replacing LIBOR, and again, not till the end of 2021, so we're still talking, 3 years away, and it's the secured overnight financing rate. It's secured by Treasury, so basically less risk than risk-free because of the secured nature of it. Again, it does not have a curve associated with it at this point, so in order to build one, there has to be some assumption about premium, for the liquidity risk as you go out the curve, in addition to what would then be the credit risk that would be associated on top of that. So, basically all the things that Michelle has mentioned in the context of how this would be built out. What we're focusing on from our perspective at this point, because we buy a lot of securities, floating rate securities that have LIBOR as their reference rate, 1 or 3 month LIBOR in particular, and essentially, we're in the money market business, so we have things that are going to be maturing way before 2021, but we have things that have puts on them that will go beyond 2021. Now, we can put them if they're not being replaced adequately, but on the other hand, what we're doing for our own internal guidelines on a legal representation and focus standpoint is to look at these contracts, look at the contractual nature of what I would call the structured securities that we're owning, and making sure that there is the ability to replace LIBOR. So if LIBOR does go away, or if it's deemed to be no longer representative of what the intention of the security financing would be, then it can be another rate can be named, with the market with the knowledge that it would be a market reference type of rate. And, we'll continue to, sort of go through that and make sure that that's in our contracts going forward, because ultimately the alternative to that is for, a rate to go to some ceiling or, basically folding up of a contract that necessarily we wouldn't want to go through those same steps. So that's our focus at this point. And again, we do think that there's, sort of plenty of time for that to be addressed, given the longer nature. In our opinion, we do think that, again, depending upon what is decided upon by the banks that are supplying this information, that there will likely continue to be some form of LIBOR going forward. It's just a question of whether that will be representative of what it currently is in the market.
Right. Clone or something entirely new. Ju Young, your thoughts?
Sure. Thank you, Kevin, and good morning to everyone. So I think both Michelle and Debbie covered the topic pretty thoroughly. I think I would emphasize a couple of the points raised in terms of the fact that the ARRC's rate is, in fact, a secured rate and an overnight rate, which presents the many challenges, I think, that were presented here. I would say that from what we're seeing, corporates are beginning to get engaged, but are really focused right now, I think, on the fallback language that Debbie was referencing. And what we are thinking about in the context for banks that I think is, I think Michelle pointed out that's very important going forward is if we have these two rates, what's the liquidity of those contracts if we move forward with LIBOR, especially if it becomes sort of less useful, and that will definitely present a challenge, I think, for hedging and having sort of a mixed book. And so there could potentially be a lot more basis risk presented to both banks and I think corporate treasurers. So I think that's one area that we're paying a decent amount of attention to. But I'll leave it at that because I think it was pretty well covered.
Gotcha. Thank you so much. Mr. Carfang, any thoughts?
Yes, I do, Kevin. Your question was, will LIBOR continue to exist after 2021? Let me restate that. Will organizations continue to price deals and manage contracts based on LIBOR after 2021? LIBOR is an index. I would argue LIBOR ceased to exist in 2008. The I fell out of LIBOR in 2008. Our chart on page 8 of this presentation shows the exponential increase in bank reserves beginning in 2008 in response to the financial crisis. In the U.S., total bank reserves went from maybe $50 billion up to the $2.8 trillion that we saw on that chart. Same's true in the 4 other jurisdictions that we measured. The interbank market, the I in LIBOR is the interbank market as banks trade reserves with each other. The central banks have come in with $10 trillion equivalents of interference and disruption in the market beginning in late 2008. So the interbank market is barely a shadow of what it was in 2008. That doesn't mean the LIBOR is no longer an effective rate, or the 10-bank panel who is submitting transactions and estimating rates and premia, isn't valid. But certainly the central banks have come in to absolutely, totally decimate the interbank market, which LIBOR up until 2008 measured.
Wow. I wasn't expecting that. Thank you so much, Tony. That's a very interesting point. Let's move on. Let's talk about interest rates in 2018 and potential inflation. And Michelle, I'm going to start with you. As I'm doing my homework and doing the research for this, we're looking at a bond market sell-off that's happening. We're seeing 10-year inflation break-even rate topping 2%. I mean, obviously it's on a rolling 9 months, but you see the sell-off. We're seeing a flattening yield curve. As I was leaving the office last night, Tony catches me and spends about a half hour showing me what's happening, and it just made my brain swim. So Michelle, let me start with you. Do we anticipate inflation to be picking up in 2018 globally? I guess is the way I would start that question.
I'm not sure I can answer it from a global perspective, but from a UK perspective, over here the Monetary Policy Committee, the MPC, they set the monetary policy, and their aim is for a 2% inflation target. You may recall here in the UK, early November, the MPC voted to increase bank rates by 25 basis points. So we've now got interest rates or base rates of 0.5%. The outlook for inflation from a UK perspective is that it's going to remain broadly similar to what it was in the past quarter. So, I mean, I guess that's as much as I can say.
Sure, sure. Debbie, any thoughts on rates in 2018 and how those might play with inflation?
Sure. From an inflationary standpoint, you know, we think similar to what Michelle is thinking in the UK, that rates in the 2 to 2.5% inflationary level will be maintained, depending upon what measure you're looking at. There are some. Sure. That are in the high 2s and some that are in the high 1s, but generally speaking, overall, you know, the 4 or 5, you know, sort of chief measures for reviewing U.S. inflation, we think will stay in that 2 to 2.5% range, which, in our opinion, keeps the Fed in a trajectory that is currently expected from their dot plots for 2018. Our outlook, similar to the Fed, is for 3 interest rate moves of 25 basis points each, probably first, second, and fourth quarters, which would ultimately take the overnight Fed funds rate then at the end of 2018 to 75 basis points higher than it is today, which would be the 2 to 2.25% level. Because inflation, in our opinion, stays in that 2 to 2.5% range, we think this flattens the overall yield curve, 2s to 10s, but we do not see any kind of an inversion, you know, which would ultimately be a predecessor in most instances to some sort of a recession.
Oh, you said the R word, Debbie.
Pardon me?
You said the R word.
Yeah, well, I'm saying we don't think that that's the case. I'm
okay, gotcha.
to refute what
gotcha.
Others have said. Along, you know, sort of the lines of the Fed continuing, though, we think that, you know, the balance sheet changes that they've noted last year will continue in 2018. We're now retiring or putting back out into the market, taking off the Fed's balance sheet $20 billion per month for the first quarter. It was $10 billion per month for the fourth quarter of 17. It's $20 billion per month for the first quarter of 18. And, you know, that will continue, we think, as planned for all of 2018. And really, by the second half, we'll begin to see a little bit of an impact in the marketplace from that, with obviously larger amounts of supply, you know, that we're starting to see already from a Treasury perspective, and then a depletion in the reserves that are required. So we think that there will be, you know, some impact from a spread perspective. As far as my market is concerned, we think this is an optimal time for money market funds in a rising rate environment. We think that the spread between money market fund product returns versus the deposit market, which has, you know, grown from $3 to $10 trillion over the course of the last, you know, almost 10 years since the financial crisis, we think that that differential will start to close, and the gap between the amount in the deposit market versus what's in a money market fund industry will start to close. So, you know, modestly rising rates, steady to modestly rising inflation, but within the Fed target range, and a balance sheet reduction program, as stated, kind of gives us an outlook, an overall outlook for the U.S. for 2018 that's, you know, modestly higher rates, but steady as she goes in getting there, with a lot of sort of opportunity ahead of time for the Fed to telegraph if they expect to do something different because of changes in the current economic conditions.
Sure, sure. Yeah, some surprise to upside growth might be met with a revised rate hike schedule. Who knows? Ju-Young, any thoughts here?
Sure. Yeah, I think we hold some similar views in relation to inflation. Our economics team is forecasting about, you know, in the low twos, so about 2.2 for the U.S. in 2018. For rates, we're actually expecting higher rates, I think, than maybe others. So our forecast, or I should say our economic team's forecast, is about 100 basis points of Fed hikes this year in 2018. So we're looking at about 25 basis points a quarter, which is a little bit different, I think, than market expectations. We're also expecting yield curve flattening to continue as a result of this, and I think you know, I think one of the takeaways is that when we think about, you know, implications for banks and corporate treasurers, we do see movement already on the corporate deposit side in terms of betas. So I think we've seen corporate treasurers demanding more, and there is still, for the large banks in particular, value to corporate operational deposits because of their sort of more LCR-friendly nature, and so we expect that corporate rates will continue to rise on deposits.
Thanks, Ju-Young. I appreciate it.
Sure.
One more topic before we go for today, and that's U.S. tax reform. We've had a lot of people talking about it, and let me start by saying, Treasury Strategies and Novantas, we are not tax experts, and we're not offering advice in any way, but the Tax Cuts and Jobs Act is kind of too big and too impactful to ignore, and it, you know, obviously it's going to have ramifications for our audience. So the interesting thing is, as I was thinking about this topic, is you know, you see anticipated growth of like 0.5% in 2018, at least according to our friends at BNP Paribas. It's interesting because as you see the tax rate being officially moved from 35 to 21, the effective rate is going to differ by industry. It's going to differ by sector. Some corporates won't even see a change, and some will see, you know, not a great one. Some of the other things I was thinking about are limits on the different deduction allowances that are going to impact firms differently depending on how they're structured globally, how they're structured physically, but also how their debt is structured, where it's issued, where it's denominated. And also I wanted to point out, you know, there's a different rate on repatriated funds. We were just looking at this, the cash and cash equivalents at like 15.5%, everything else at 8%. So Debbie, let me start with you. When we see the Tax Cuts and Jobs Act come out, you know, what are your thoughts here going into 2018 with respect to U.S. tax reform?
Sure. Well, I guess probably three different parts. Number one, I'll put my credit hat on and look at the issuers that we purchase within our portfolios. And I have to say, you know, it will differ across industries, sectors, firm-specific, but overall we think that there will be, you know, a marginally positive impact on credit. And credit is already something that is, you know, not on the top of our radar screen as a problem in 2018. So, you know, we think it's a minor positive from a credit standpoint. If I look at the individual sectors within my market, I think the muni market will be impacted more than the taxable market in this in these changes. Number one, from a supply perspective, certainly some of the product that will no longer be able to come to the market in a tax-free form will, you know, limit, again, marginally the amount of supply that we have within our municipal markets to choose from. We also think, though, that the value of the state-specific products in the muni market will be increasingly higher for individual and corporate investors. We think that, you know, because of the limitations from a deduction standpoint, that the value of owning a state-specific product, especially now that we actually have yields on those products where the where the deductibility, you know, where the state-specific aspect of it makes some sense, will be particularly attractive in the 2018 time period. And then finally, when I look at it on the taxable side, I think the impact there will be mostly in the context of additional flows, those flows coming from a repatriation side of the equation, which, you know, estimates there, I think, you know, Kevin, you alluded to, are all over the board, you know, from, you know, hundreds of millions to many billions. And, you know, overall, I think it'll be a slower process than the asset flows, the positive asset flows that we saw into government money market funds during the 2016 reform time period, but we do ultimately think it will be the government products that are the recipients of much of that repatriated cash, but that it will be a period of time, you know, from a slower perspective that gets that cash back into the U.S. because ultimately the underlying corporates have to pay the you know, the price for that, so they might as well move it back into the U.S. if their business is, you know, centered here and makes sense for them to do so because they're going to be paying the fee for it anyways. But we think that occurs over a slower pace of time.
Gotcha. Thanks, Debbie. And before we close out this session, Ju-Young, any thoughts from you on tax reform?
You know, we're taking a pretty deep look at this, particularly for banks, and I think some of the, you know, quick and dirty outcomes that we're coming to conclusion is that, you know, in the short term, there's definitely going to be some pretty big hits for the banks in terms of the earning write-downs as a result of writing down their DTAs and the repatriation of foreign earnings back to the U.S. And then there's the small impact of a lot of the banks, and I'm sure corporates are doing this as well. We just saw Walmart is increasing their minimum wage, and, you know, we're seeing some one-time bonuses. That impact is actually a lot smaller, but we think longer term, the benefit from having that higher earnings retention will outweigh that. Capital-wise, I think it's not going to be as impactful just because most of the DTAs are taken out for regulatory capital, at least, because NOLs are deducted. The other thing is, you know, I think we're still looking at what it means for the debt markets and how it's going to impact corporates' behavior in terms of, you know, this will mean more cash on balance sheets, and debt financing may not be as attractive with the lower tax rate and the reduction in the interest tax deductibility. We're also spending some time trying to understand the base erosion and anti-abuse tax, which is similar to an AMT for multinational corporates, and what that might mean for banks and securities firms in particular. And so we're spending some time, but those are some of the things to look out for. And I think that the base erosion and anti-abuse tax will affect corporates as well. So it's an area that we're spending some time figuring out.
Gotcha. Thank you so much. Thank you so much. And thank you to everyone who participated in today's panel. Michelle Price, the Associate Policy and Technical Director with the Association of Corporate Treasurers. Debbie Cunningham, Chief Investment Officer for Federated Investments. And Ju-Young Lee, Managing Director for Fitch Ratings. Tony doesn't get credit for being part of the panel. I'd also like to thank Denny McMahon again from Macro Polo for his time today. As usual, a link and a copy of today's materials will be shared with everybody that's registered in a few days. And again, if you have any questions, comments, whatever it is, please feel free to contact me or any of the panelists at our respective emails. Keep in mind also that starting this year, starting with today's webinar, this is now eligible for AFP credit. I believe it's CTP credit, and I believe there's another one. If you have questions on that, please reach out to any of us, and we'll clarify that for you. And finally, please follow up on the survey for the State of the Treasury practice. That'll be in 2 weeks, and we are very much looking forward to hearing that. On behalf of everyone today, thank you so much for listening. We look forward to seeing you in April. Thank you very much, and have a great day.